Brought to you by Raisin UK, the smart choice for savers who want strong returns without the legwork. What's more, for a limited time only, you can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. For more details, please visit the link below or go to raisin.co.uk/PensionCraft. Welcome to Many Happy Returns, where we aim to make you a better investor. Big changes could be coming to ISAs, the tax-free savings wrapper used by 22 million Brits. Chancellor Rachel Reeves is preparing a major review of the ISA market, aiming to nudge savers away from cash and into stocks and shares.
Could we soon see a cap on cash ISAs? And if so, how might that reshape the way millions of us save and invest? And in today's dumb question of the week, what is the cost of capital? All right, let's get into it. So, Romin, it looks like it's that time again when politicians talk about fiddling with ISAs. Now, it's a risky business, isn't it? Because people love their ISAs. They're a British institution. Probably only behind the NHS, triple lock pensions and the Boots meal deal. You mess with them at your peril.
And they're great. I love ISAs, and I think they're a great way to save tax-free forever. And they provide huge flexibility in retirement because you can withdraw money from them and it doesn't affect your income. It is just withdrawing from your savings. So as a flexible tool for saving, I think it's just great.
So what's the problem then?
I think for me, the problem is that it's so complex. There are so many different types of ISA, and each new type of ISA that you create creates exponentially more complexity because you're thinking about things like, well, can I transfer from this type of ISA to that ISA? How does it affect my ISA limits? What are the constraints on who can pay into these ISAs? And, it just gets so bewilderingly complex that really I think it's due for some kind of cull.
Romin, is it that complex? You've got stocks and shares ISA, you've got cash ISA, you've got a lifetime ISA with a different limit that you can only use to withdraw to pay for a house deposit or potentially save for your retirement. You've got an innovative finance ISA, which no one uses. You've got a junior ISA, two types of junior ISA, in fact, cash, stocks and shares. You've got a retired help to buy ISA, which you can keep open but you can't add to. And you have a potential British ISA, which may or may not happen. It's not that complicated.
Yeah, I stand corrected.
So what is the government talking about then? Is it saying this is too complicated, people don't understand it, or has it got a different motivation in mind?
Look, understandably, they've got the bit between their teeth when it comes to growth. And when it comes to growth, cash ISAs may not be a good way of stimulating growth. Because really all you're doing is stuffing money under the tax-free mattress. You're not putting it into the economy. Whereas if you buy stocks and shares, you could argue that that's more stimulative for the UK economy.
I guess from a policy point of view, you could make the argument that if we're giving people a tax incentive, it should also help the British economy, which arguably cash savings don't. So if you look at what the government said in the spring statement, they said they're looking at options to reform ISAs to get the balance right between cash and equities so that savers earn better returns, we boost the culture of retail investment, and we support our growth mission. So there's two different justifications going on there. One is around, well, people will be better off if they buy more stocks and shares and less cash. No real arguments from us on that point. Mm-hmm. And also that it will boost growth. Are those goals compatible?
Well, you could argue that with cash ISAs, what could happen is that if lots of people pile into them, the types of instrument which those funds buy would be things like short-dated UK gilts, also commercial paper, also certificates of deposit, and those will push down short-term rates. So you could argue that that's going to reduce the cost of capital. And we'll talk about that later.
I think a lot of people were worried that the government might scrap the cash ISA entirely. That doesn't seem to be on the table. The rumours are that they could put a cap on the amount of cash you can hold in ISAs, potentially £4,000 a year, I've seen floated.
So that would be a cap on how much new money you could put in every year rather than the absolute amount that you reach.
But Rachel Reeves has been clear that she's not going to reduce the total £20,000 allowance. So she spoke to the BBC recently and she said, I'm not going to reduce the limit on what people can put into an ISA, but I do want people to get better returns on their savings, whether that's in a pension or in their day-to-day savings. At the moment, a lot of money is put into cash or bonds when it could be invested in equities, in stock markets, and earn a better return for people. One of the reasons we are looking at the advice and guidance that financial firms can give to their customers is to make sure that people are making informed decisions about how to invest their money. whether that's their pension savings or their ISA savings. I absolutely want to preserve that £20,000 tax-free investment that people can make every year. So that's good news, I guess.
Yeah, freezing it at 20,000 in real terms, that's not going to be great because clearly inflation has eroded the amount you can put in every year. But not reducing the total ISA limit, thank goodness she's not thinking about that.
I guess the first question that comes to mind is, are we getting obsessed by the right thing? Are people putting maybe too much into cash savings and not enough into stocks? Now, if you look at the stats, and the latest figures I have are for 2023, in that year, just over £70 billion was added to adult ISAs, the overwhelming share of which was into cash ISAs. And actually more and more money seems to be going to cash ISAs. So 10 billion more than the year before. Whereas stocks and shares ISAs saw 6 billion less money subscribed than the prior year.
I think the shocking statistic for me was that just under 2/3 of the 22 million ISA holders only hold cash ISAs. So that's pretty shocking. Only 1/3 of the ISA holders put money into stocks and shares, for example, at most.
But interestingly, if you look at the total amount of money that's built up in ISAs over the years, the lion's share is in stocks and shares ISAs. So it's around 60% in stocks and shares ISAs versus 40% in cash ISAs. And I think that just demonstrates that these stocks and shares are growing faster than cash. People are putting more money into cash, but it's growing very slowly.
And over time, what you would expect is that the greater capital growth in stocks and shares ISA would make them start to dominate cash ISAs purely for growth reasons. It's not just about how much people are putting into each of the different types each year. And I just hope the message gets through that if you do put money into cash, you'll underperform by about 4 or maybe even 5% per year.
On average, over the long term. But maybe that's the point, that not everyone is saving for the long term, right? There are reasons to hold cash if you're going to need the money in a few years.
Yeah, look, as a mixture of different types of investment, I think it makes sense to have cash sometimes. And it depends on your circumstances. Like you say, if you need money short term, you'd be crazy to put it into stocks. But that's why I hate the cash ISA, because it's almost like you're asking a painter to paint in only one colour. Sure, you've got artists that went through, say, a blue period, but would you ask a chef to cook only with water? No, it would be impossible. You can't make a recipe out of one ingredient. And I think that's why people misunderstand cash ISAs. It forces you into one low-returning asset class, when in fact what you could do is have a stocks and shares ISA with money market funds in it, which would give you very similar returns as you'd get with a cash ISA.
And in fact, there have been proposals from some in the industry, notably AJ Bell, to sort of merge cash ISAs and stocks and shares ISA into a one ISA approach where you can hold anything in there.
Now, personally, I like that approach because it does mean that you've got a greater flexibility in terms of what you do. At the moment, if you decided to move money out of your cash ISA into your stocks and shares ISA, it could take a while for the transfer to happen. Whereas if it's already in the stocks and shares ISA, you've got greater flexibility in timing in terms of moving money out of cash and into stocks.
I think one of the key downsides to merging these things is that cash ISAs are very well understood and very popular. There's been quite a lot of research and people love their cash ISAs. They're simple and not everyone wants to buy stocks and shares or is comfortable doing so. And I guess the case the government makes and the industry makes is if you combine them into one product, yeah, people might hold their money in cash, but they'll be tempted and curious about these investments that are now open to them and might learn about it and put some money into stocks in time, which would meet the government's missions of boosting the UK stock market and providing capital to UK businesses potentially. But I guess it's an empirical claim, isn't it? Would merging these ISAs or scrapping the cash ISA, would that get people to invest more? We don't know. Because there's always the danger that fiddling with the rules on these products puts people off using them. You know, they think, well, the rules are just going to keep changing. I can't trust them.
Yeah, as long as the accessibility of the money didn't change, that would be awful if they didn't let you take the money out or if they put a huge cap on what you could invest in or really constrain what you could invest in such that it's less attractive. But I think cash ISAs are a kind of gateway drug people get into cash ISAs with their savings, and then perhaps they think, oh, look, I could put my money into this stocks and shares ISA. Look at what's happening in the stock market. I could have got much better returns. And it is the job, I think, of influencers to really educate people about the greater return you get with equity than you do with cash. So hopefully that message will get through to the UK public.
Yeah, I agree with that. We do underinvest as a society. It's probably hard to argue against that. But I can see some potential downsides to hobbling the cash ISA. If people don't invest more and they decide, well, I've got this money, I want to keep it in cash, I'm going to hold it in a taxable savings account, then that might slowly pull more and more people into the self-assessment tax regime, which is an administrative burden both for them and for HMRC. It doesn't take much now to go above the personal savings allowance.
Yeah, that's a really good point. And I love ISAs because they keep me from having to report my tax, because I just try to keep it really simple. And once you get into personal savings allowance limits, you just think, oh no,
I've got to track all my bank accounts, yeah.
Or excess reportable income. I mean, even just thinking about that phrase makes me shudder.
Like we said, cash ISAs are popular because of their simplicity, but it's not just the general public that loves them. There's been quite a lot of pushback from building societies who say, don't take away our cash ISAs. They're a really important funding source for us, which allows us to offer different mortgage products to borrowers and keep costs down. They make the case that were there cash ISA customers to desert them, then there'd be fewer mortgage products available and probably at higher interest rates. Obviously, they've got an incentive to say this. Whether they're right, I don't know.
And this comes back to the point about lending to the real economy. I think cash ISAs do provide capital for banks, and that is a way of essentially allowing them to increase the size of their lending book. So you could argue that there's an indirect growth benefit, and it is channeled specifically to the UK economy. Whereas if you invest in stocks and shares ISAs, the chances are it's going to be spread out throughout the global capital markets, of which the UK only makes up 4%.
And there is a multiplier effect there, I guess. If you deposit £1 in a bank, they lend out far more than £1. But then again, cash ISAs are typically runnable money, which might make banks wary.
And now that we're starting to see interest rates fall as the Bank of England cuts interest rates, it is likely that we're going to see money move out of these cash ISAs. Okay, when it was above 5% for something that was almost risk-free and inflation was below 3%, well, that was pretty tasty. But if it comes down to 3% annual interest rate, not so attractive. And going back to your point about why cash ISAs are popular with the public, we had a lovely comment from one of our members who said, in working class families, any sort of investment apart from a savings account is seen as gambling. My dad's horrified by my opening a stocks and shares ISA at the age of 55, and I had a long lecture from him about my foolishness, which I thought was great.
That was the privilege of a generation with defined benefit pensions. They didn't have to think about the gamble that was being taken on their behalf. But it's a fair point. If you look at the surveys around attitudes to risk and gambling versus investing, a lot of people in Britain will describe investing in stocks as something as not for me. It's for other people to do. It's complicated. I don't need to get involved in that. I don't have the kind of capital required. Obviously, that's not true. We know that's not true. We talk about it every week. But it is a pervasive myth.
And again, I think the government really has an onus on it to actually educate people about this. And it should be all the way through life. It should be part of our school education. It should be part of our ongoing education. Even if it comes down to having advertising campaigns on TV, talking about the relative benefits of investing in equity, I think the way they're messaging this is very poor. And I remember those ads from the 80s where we had privatization of things like gas. And these ads were quite funny. They got an agency to produce really good quality ads that were entertaining. And people talked about it. I still remember people talking about it in my school.
Tell Sid, before my time, but even I know about it.
And I looked back at the ads and it was kind of interesting because they were actually co-funded, the ads, by various brokers at the time.
That doesn't surprise me one bit. You see the lobbying going on around all this ISA reform at the moment. All the brokers are like, yeah, it just makes sense to push people into stocks and shares. Send them our way. I mean, not saying they're wrong, but they have dual motives.
Sorting your savings shouldn't mean juggling websites or doing hours of research. Raisin UK streamlines the whole process. With one login, you can explore and manage savings accounts from across 40 plus FSCS-protected banks, all in one place. What's more, for a limited time only, you can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. For more details, please visit the link below or go to raisin.co.uk/PensionCraft.
Okay, so far we focused on the cash ISA and how it might be in the crosshairs of the government, potentially to be scrapped, though I think that's unlikely, potentially to be capped, possible, or potentially to be merged with the stocks and shares ISA. One thing about that merger plan that could alarm ordinary people is how it interacts with the FSCS protection, whereby the government guarantees £85,000 of your money in the event of a failure of a platform. How that would work with a merged ISA that's potentially offered by an investment platform is not clear because the rules work in slightly different ways.
Now, there is a difference between a cash ISA and a money market fund inside a stocks and shares ISA. There is a difference, and it is safer to have cash in a cash ISA. And that's because in order for what effectively is a cash deposit at a bank to lose value, the bank itself would have to suffer some kind of adverse event. And here we're talking about bank failure. And in that eventuality, you'd be protected with the FSCS guarantee. Whereas with a money market fund, if the value goes down because there's a freeze in the commercial paper market, well, you're not going to get a guarantee in that case. It's just the investment going down in value.
Which is very unlikely to happen in theory. These are seen as cash-like instruments. But it can happen, and there are occasions in history where it has happened. People have lost a small amount of money.
A very small amount, and this was in 2008. But look, that's such an unlikely event that I think that the extra protection you're going to get is not really significant. But it does make people worry less. I know that because so many people talk to me about platform failure. It's almost always a question I get asked for someone who's not used to investing. If I put all of my money into this platform, is it safe? Is it going to go down? What will happen if it goes down?
It's an absolutely fair question. People are thinking about the right thing. As they get into investing, they've got to get comfortable with it. And, there's a huge concentration risk, but it is mitigated significantly.
And there are all sorts of other protections. Keeping client money separate from firm money, that's probably the most important, I'd say. So even if the platform goes into liquidation, it's extremely unlikely that they're going to take out your money to pay the liquidator's fees. It can happen. There can be a Barclay Applegate order, which is imposed by the courts in order to pay the liquidator if there's insufficient funds from the platform itself.
Yeah. The thing is, it's much less simple to explain, right? The FSCS guarantee on cash is pretty straightforward. Even in the worst case, my bank blows up, I'm getting up to £85,000 of money back. Whereas here, we've got to talk about all the caveats and how there's client segregation and there's money market funds that invest in safe stuff. The duration is short. All this stuff people don't understand typically.
Yeah, once you get onto the concept of duration, people's eyes glaze over in my experience.
I think if you were to merge cash ISAs with stocks and shares ISAs, you'd have to just allow people to still hold their money in cash with an FSCS guarantee. And I guess there would be nothing to stop the banks and building societies that currently offer cash ISAs offering these kind of one ISAs, but only with a cash option. Like they just don't even offer the investment products in there. Because there's no obligation on ISA providers to offer the full range of things. A platform like Vanguard only offers its own products, for example.
But coming back to the whole ethos behind these changes, I think it should be about simplification. We shouldn't have such a complicated array of different products. And every time the government decides to change the regime, it's moving in the direction of more complexity. For example, the previous Conservative government was talking about a British ISA, which would have introduced another product where you get an additional 4K per year to invest into UK equity exclusively. And then you get even more complexity when it comes to transfers, allowances, and it's just too complex, I think, for the average person to understand.
Absolutely. And I think it keeps getting more complicated because there are these competing visions and motivations for what the government is trying to get out of the ISA system. So the whole idea of the British ISA is because there's this feeling, maybe justified, that the British equity market is unloved, unfairly undervalued, and that's causing problems for British companies. You know, we're seeing some of them delist from UK exchanges and move abroad. We're seeing fewer IPOs in the UK. Private equity is increasingly buying out our public companies. And ultimately, returns have been poor for the UK stock market, and trading volumes are low at the moment. So there's this goal to fix that, and the idea that, oh, there's a lot of money in ISAs. Maybe we could use that to fix the problem. But you can make it worse, can't you, if you make things complicated? I'm glad the British ISA has gone away, though we are still hearing talk about how to boost the UK stock market using ISAs. So I hope there's not some sort of British ISA by the back door where they bring in complicated rules about asset allocation and how much must go into British companies in an ISA. I think that would be a disaster.
Now, personally, I don't like the idea of forcing investors to invest in a specific market, particularly if that's a market which has had a poor performance. I can understand the reasons behind it, but if you look at the total amount invested in UK ISAs, it's just under £1 trillion. And the UK equity market is £4 trillion. So perhaps it would move the needle if we forced people to invest in UK equity. But if that comes at the cost of lower performance, then I think it runs counter to the whole reason why we allow savings in stocks and shares ISAs in the first place, which is to get a good long-term return, tax-free.
Yeah, forcing people to reduce their diversification just because you want to juice your domestic market is probably not the way to go. As you say, I can see why it's tempting for a government that wants growth and wants business on side. But I think there are just so many unintended consequences. For a start, how do you define British? Is it just anything listed on a UK stock market? Well, there's 1 million dual listed shares out there. Companies change their listing location all the time. What happens when they move abroad? Can you not hold it anymore? Do you have to sell it? Is that a taxable event now?
Yeah.
And most people aren't holding individual shares. They're holding funds, which invest in assets all around the world. Does it count as British if I buy an S&P 500 tracker on the London Stock Exchange? Like, to me, it doesn't really make a whole lot of sense. There's this complexity, which would be a cost burden, I assume, to the platforms. It would also have the risk of compliance, and it would potentially put off investors. And to be honest, I'm not even sure it would actually meaningfully reduce the cost of capital for UK companies anyway. It's a bit chicken and egg here. Have they underperformed because they're unloved, or are they unloved because they've underperformed?
I think a greater benefit for the UK economy would be easier funding for startups and mid-caps. So these are companies which are just in need of capital. That's their kind of explosive growth stage. And there, I think, in the UK, we do have a problem. If you live in the US, it's much easier to get second-round funding or even first-round funding than it is in the UK. I know that because some of my clients are UK startup founders. And they just say it's disproportionately easier to go to California, get on a plane and get that capital very easily than to try and do it in the UK, where people are much more cautious about failure.
I think that's true, but I also think ISAs aren't the way to solve that at all.
And we already have schemes for that in the UK. We've got VCTs, we've got EIS schemes, SEIS schemes. So I think that's already in place. And I'm not convinced that if you buy FTSE 100 trackers, that it's somehow going to boost the UK economy. So I just don't think this is well thought through in terms of stimulating growth.
Yeah, I agree with that. I think if there's a problem, it's structural with the British economy. It's not the problem with markets as such.
Now, there was a brilliant report from the Pensions and Lifetime Savings Association called Pensions Growth, Creating a Pipeline of Investable UK Opportunities, where they talked about investing in the UK and how they could work with government to try and get better stimulus. And one of the concepts I like best in that document is about blended finance solutions. So this is where the government takes some kind of risk off the table by investing their money alongside private investment.
Oh, yeah. Good old public-private partnerships. Nothing's gone wrong there before, Robin.
But look, this is something which has actually worked well in the past in some projects. And I think for things like energy projects, for example, where you want some kind of reduction of the risk because there's a huge investment on the part of the private company, there, I think some kind of guarantee would be very useful in order to get capital on the table from private sources. So in the UK, we've got things like lifts, and that's designed to support investment in UK startups. So those kind of schemes, expanding those, maybe making tax incentives for the pension funds, all of that I think could help stimulate growth. But forcing UK retail investors to plough more money into UK stocks is just not going to work, I don't think. And in fact, I think if you did force people to invest in the UK, it's a very weird stock market, which is very concentrated. It's got strange sectors which dominate. And I think the underperformance that's likely to result from that is probably going to put people off investing in stocks anyway, which is not the intended consequence.
I don't think they'll do it. I think it's too complicated, even if they wanted to. But let's talk about some other potential reforms that they could sneak in alongside whatever they decide to do with simplification and consolidation of the market. So as it stands currently, you cannot hold cryptocurrency in an ISA, at least not directly. What do you think? Should that change?
I think the way to do that is to have ETFs, which give you exposure to cryptocurrency, because you could trade those on regulated exchanges. It would give you the exposure you're after, and you wouldn't have to go to one of these dodgy cryptocurrency platforms in order to trade it. But I think having it directly inside the ISA is a mistake, certainly while the platforms themselves are unregulated.
Okay, another potential reform. At the moment, in a stocks and shares ISA, you can only hold cash in sterling, which means that if you're trading, let's say, US stocks, often when you're selling them and buying them, you're moving in and out of currencies all the time and incurring fees to do so. Should you be able to hold cash in other currencies in an ISA?
I think that's a marginal benefit, so I think it's unlikely that they're going to allow that to happen. Would it make sense to do it? I think it probably would, given that you're allowed to hold foreign stocks anyway. So effectively, what you've got is foreign currency exposure anyway. Whether you hold that in the form of foreign cash or foreign stocks actually makes no difference.
Another point I hope the reforms address is what to do with the lifetime ISA. So just to remind everyone, this has a separate subscription limit of £4,000 per year. The government will top it up with a 25% bonus, but there are restrictions on how you can use the money. You can use it for a deposit to buy a house, but the value of that home cannot exceed £450,000, and it's been capped at that level since April 2017, not kept up with inflation. If it had, it would be more like £560,000 now. And I think whenever you get these hard caps in legislation and in the tax system, it just creates such weird incentives. You can also hold your lifetime ISA until you're 60 and then start to withdraw it without penalty at that stage. But if you withdraw it before then, you incur a 25% penalty, which, because of the way the maths works, actually is a little bit more than the bonus you received, like 6.25% more, which again seems strange. I think there's a good case for reforming lifetime ISAs somehow. Definitely by pushing up the property value limit, probably with scrapping the penalty, so the government just takes back the bonus basically if you take it out early. And maybe by increasing the subscription limit, because it's been stuck at £4,000 for a long time.
Yeah, this one is so weird that I think it's odd just to call it an ISA in the first place. Maybe they should just call it something else, because it doesn't feel like an ISA at all.
Yeah, I agree. I think one of the big problems with it is the name Lifetime ISA, and selling it as if it's a kind of quasi-pension almost. It confused the pension market, I think, as well. If it was up to me, this thing would never have been introduced and I'd scrap it now. I'd be unpopular for doing so. But I don't think the British public need more demand incentives around the housing market. People are perfectly willing to save and buy houses on their own.
And it is just propping up a housing market to keep prices artificially high. I think that's still a problem in the UK.
No, it's to help people onto the ladder, Robin. If we give money to everyone, what's going to happen? Anyway, there's a big question around that. I think there's also a big question around the innovative finance ISA. And here, I'm just going to be blunt, scrap it.
Yeah, I never saw the point of that one.
Well, there was this era, wasn't there, where everyone thought peer-to-peer lending is the next big thing. It's democratization of finance, moving away from those old dusty banks. But in truth, it never really happened, did it?
No, and I think people didn't understand the risks involved. It's very hard to lend. Lending is just difficult. And I think if you put lending into the hands of individuals, it becomes even more risky.
And I think it's the case that these kind of peer-to-peer platforms were like where a business would go after everyone else had turned them down. So you're getting such risky borrowers that, yeah, certainly I don't think there should be a tax incentive for this kind of lending. So I would just scrap it and find a way to, over time, fold them into normal ISAs.
I can see the justification behind it. If you want to provide capital for companies to grow, then it is a way of allowing technology to marry people who have capital and people who need it. And I think that was quite interesting. But having that as an ISA, again, I think just confuses things.
Now, I think we should maybe just touch on some of the more extreme proposals that have floated out there over the last few years. So at one point, the Resolution Foundation, which is a prominent think tank, they recommended that the government should cap the total value that any individual can have in their ISAs at £100,000. That would be a big change. At the moment, it's unlimited, right? If you get good growth and you're maxing your ISA out every year, you can go up very fast towards £1 million plus. Now, I only mention this really because the Pensions Minister, Torsten Bell, was the chief executive of the Resolution Foundation at the time of this proposal. So it would seem so unpopular that I doubt it's going to come back, but you never know, right?
And again, this is going to create a disincentive to save. If you cap how much people can actually make in the ISA, it's great to think that you could be an ISA millionaire, even if it's unlikely you're going to reach that goal.
I also think it's one of those things, like I said, about hard caps in the system, which create very bad incentives. Let's say there was a cap of £100,000. I'm investing, I'm doing really well, it's growing. Oh, I'm up to £90,000. Well, now it makes sense to take risk off the table and put it in very safe assets, right? Because I don't want to exceed the £100,000 cap, which is exactly the opposite of what the government wants. So these things don't make a lot of sense.
Now, the one thing I hate about the UK stock system is the fact that you have to pay stamp duty. It is a big transaction tax if you buy UK stocks. So this is a 0.5%. It's not an absolute amount that you pay. If you buy more stuff, you pay more tax. Now, if you compare that with other countries like the US, that is a very high tax. And it puts people off trading, which isn't necessarily a bad thing. It stops you trading too much. But it disincentivizes you from buying UK stocks when you wouldn't have to pay that if you bought foreign stocks.
Yeah, if the government's looking for a quick win, how to incentivize more money into UK capital markets, getting rid of stamp duty on the purchase of shares should be top of the list in my book. But maybe the bigger problem here, if the government's thinking, well, how do we get the great British public more into investing, comfortable putting money into the stock market? Is it a question of education?
I think it is. And I think the difficulty faced by teachers is they don't know about it themselves. If the teacher doesn't know, then how are you going to teach the pupils? For example, I had one person who actually runs courses for teachers who asked me to provide some education for the teachers themselves for investing their own money. And that's the place to start, perhaps, which is to educate the teachers who can then educate the students. Maybe that's the best way to approach it. But it's also a question of what you teach the teachers and what's on the curriculum. And I think things like base rates, where you just teach them the average long-term returns of various investments, that's so important. Asset allocation, the effect of fees, how to choose a platform. All of these things are probably not going to be part of the syllabus.
Well, I've got the advice from the government here on the syllabus. So Key Stage 3, which is 11 to 14-year-olds, should know about the functions and uses of money, the importance and practice of budgeting and managing risk. So not really about investment there. It's more about why you might not want to invest. And then if you go up to Key Stage 4, which is age 14 to 16, they should know about income and expenditure, credit and debt, insurance, savings and pensions, financial products and services, and how public money is raised and spent. So it all sounds like good stuff. But I guess what the teachers would say is, our time is precious, right? We're teaching so many different things. Whatever you add in necessarily means something else coming out of the classroom. To be honest, when I was at school, I don't even remember learning about any of this stuff. I don't even know if it was on the syllabus at the time. I don't think it was. I have seen some stats recently, actually, that despite these lessons happening in schools, 61% of young people do not remember receiving any financial education at school, whereas only 29% do remember.
The fact is, most of the young people are going to get their investment education off platforms like TikTok, which is not necessarily a bad thing. There are some good finfluencers out there. But I just feel as if there is something lacking here. When I left school, I had no idea about what I know now.
Yeah, I just think it's really hard to get kids to take it in at that age because it all seems so abstract. AJ Bell had a good publication around ISA simplification and education as well. I'll just read a quote from it. It says, It's at this point of education where the financial services industry often takes a wrong turn. People say things like, we should put finance on the national curriculum, we need to teach this stuff in schools. But financial literacy education was added to the national curriculum in September 2014. It didn't work. Research proves that the elapsed time between the intervention and the decision point renders such education largely ineffective in helping citizens to navigate the complexities of the financial services landscape they encounter through their adult lives. And to me, that makes a lot of sense. Like, you can teach people stuff at 14, but will they remember it? Like, people taught me French. I got an A in French. But if you put me in a French ski resort, I am struggling to order a fondue.
Maybe the best way to do it is via doing. You have trading games. So you teach people how to do it by saying, look, this is what you can invest in. We're going to run a competition. In the first year of senior school, you're given a paper portfolio and you have to maximize your return over the remaining years of your education. Something like that.
Yeah, I think it's key to align incentives often. So make it real. Put the school budget in the hands of the pupils. Then they've got to be taught well or they'll blow the money. So everyone's aligned, pupils and teachers.
But you know what they're going to do? They'll just put it into crypto.
And the schools will be rich.
Or... Now, financial education is something which is close to my heart because that's what we do in PensionCraft. And we've got a special offer which is running for the month of June where you can get a 75% discount on your first month's membership. Just use the code SAVE75, all uppercase, all one word, when you sign up for our membership. And you'll find more about that in the show notes.
Okay, today's dumb question of the week. What is the cost of capital?
Now, at its simplest, it's the cost of raising capital for a company in order to finance its projects. Now, it sounds simple, I know, but in fact, it's incredibly complex to estimate. So let's imagine that we're running a company. We've got various choices about what's called capital structure, how we fund our company. How much of it is equity? So here we're giving control of the company to somebody else. They get shareholder rights to vote in meetings. And it's perpetual capital. We never have to pay that back. Or we can issue short-term debt, which matures on a certain schedule, where essentially those people don't have a say in how we run our company. But that combination of equity and debt is very important when it comes to assessing the risk of a company, its business risk, but also its cost of capital. Generally, the more debt you've got relative to equity, the more risky it is, because if you miss an equity payment, a dividend, it doesn't really matter. If you miss a bond payment, however, your company goes into default.
So the cost of capital is effectively the blended average of these two things, what you're paying for your debt and what you're paying for your equity. And once you know what that is, it gives you the hurdle rate for any new investments and projects that company might undertake. So if you're looking at building a new factory, for instance, you have to say, is the return on that investment going to be higher than the cost of capital I'm paying to my bondholders and my shareholders?
Yeah, if your return of capital is less than your WACC, your weighted average cost of capital, you're in big trouble.
Okay, you brought up a new phrase there, WACC, weighted average cost of capital. Should we run through that very quickly and then call it a day and go to the pub? Okay. We're recording this on a bank holiday, Roman.
So this is just a weighted average cost of capital, depending on the proportion of capital you've raised via equity and via debt. And when it comes to valuing a company, one of the key ingredients is this weighted average cost of capital. And you might have thought, well, it's a really clearly defined number and there's no subjectivity when calculating it. Well, you guessed wrong.
I think you can be objective when it comes to the debt. So the cost of capital is effectively the interest rate. But when it comes to equity, yeah, it's a subjective judgment. And it depends on the risk-free rate, the equity risk premium, your assessment of future returns, market expectations, and even the beta of the individual stock.
Now, having talked to a lot of people who worked in equity capital markets, the way they estimate this is more of an art than a science. But you look at things like comparable companies, which are in the same sector, in the same country, and a lot of subjective stuff goes into these assessments.
One thing I think people don't instinctively understand is that when you're looking at capital structure and your options of debt and equity, raising money for your company, it's not necessarily about just piling up on whichever funding route is cheapest. Often debt might be cheaper than equity, partly because they're higher up in the capital structure. They'll get their money back before shareholders, but also because there's certain tax incentives to debt. So why not just pile up on debt? Well, it's less flexible, isn't it, like you said, than equity. And it makes the financing risk of your company higher, which perversely can raise your cost of capital, right? So it's this balance between debt and equity is a tricky one, and is why CFOs might get paid so much.
But bringing it back to the original topic of this podcast, which is ISAs and reforming them, a lot of the arguments behind pushing UK investors into UK equity is that the UK WACC, weighted average cost of capital, is high relative to other countries. And by forcing people to buy UK equities, it should, in theory, reduce the WACC for UK companies.
This is one of those things where it's really hard to disentangle the incentives, because that argument invariably comes from UK investment banks and brokers. You'd think they'd be throwing stats at us, telling us the cost of capital for the UK versus peer countries. But I have not seen that research. It's hard for me to tell whether equivalent companies in the UK versus Europe or America are actually incurring a higher cost of capital. If this is the key argument for why we should tilt ISAs towards the UK, I'd want to see some hard numbers behind it.
And I think it depends on which pool of capital you're fishing in. If you're looking at large caps, companies like Shell, companies like AstraZeneca, I'm not convinced that their WACC is higher because they can get capital from any markets in the world. Okay, for UK micro caps, small caps, yeah, the cost of capital might be higher because people in the UK are more risk averse. They're not willing to hand over capital on the basis of a poorly argued PowerPoint presentation, which you could argue that some investors in California are. So, okay, maybe WACC for UK startups is higher, but for multinational companies which are listed on UK exchanges, I'm not convinced that's the case. And frankly, that's what most people who invest in UK ISAs would be buying.
It's also the case that we had a long period of time where risk-free rates were on the floor, equity risk premiums are extremely low, the cost of capital is extremely low, and yet British businesses still didn't invest their money.
Yeah, it was a period of massive underperformance for the UK market relative to the US, say.
So now that rates are higher, really the argument is, we're just going to push them back down to where they were and that'll solve the problem. But, it didn't the first time round, so why would it now? Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.